If you are not outperforming inflation, then you are holding an ice cube on a hot summer afternoon. A lot of people focus on what to buy rather than how much to buy. But empirical studies have proven it is how much you buy that makes the difference to your wealth rather than what you buy.
Hello and welcome to Ep.3 of Investments Ki Baatein with Nilesh Shah, your go-to podcast for everything to do with investments. In today's episode, we are going to be talking about building a portfolio. There are hundreds of investment products out there and some of them promise great returns. But does that mean that you need to invest in all of them? Well, the simple answer is no. In today's episode, we are going to be talking about the must-have products in your portfolio. Nilesh Shah, the MD of Kotak Mahindra Asset Management Company Limited, will be joining us to decode complex investing strategies and help you build a portfolio that secures your tomorrow. Hi, Nilesh, and thank you so much for joining us on yet another episode.
My pleasure to be here.
Now, as we kick off this episode, I want to talk to you about why investors should invest. Right now, India is a 4 trillion roughly dollar economy. Now, our ambition is much, much more, but the near term is we're looking at $5 trillion. So in this $1 trillion and beyond, what are the opportunities for investors?
See, for our previous generation, their kids were retirement solution. For our generation, I'm sure your kids will be fine and taking good care of you. But why take risk? Why not invest so that they can manage our retirement or our other goals? Everyone needs financial security. And for financial security, it is important to invest rather than just save.
Now, the question is where to invest. There are multiple products available out there, and it's very common to get that tip from a friend or a colleague that, this is the product to be in. Aajkal, there's a lot of derivative trading also going on. So, Nilesh, my question is it necessary or do you think it's important to really go out there and explore every investment product?
So if you go to a city and there are thousands of restaurants, do you go and try every dish? Answer is no. You have a palate, you have a diet, you follow that. Same thing is true in investment. There are hundreds and thousands of products available. It works for someone, it doesn't work for someone. You have to do what is appropriate for you. There's no need for you to invest across all the products. In that process, you are unlikely to ever get financial security. Suniye sabki, kariye apni.
So we know now where not to invest. Now, of course, let's talk about where to invest. Now, we are in 2025. If you could recommend to all of our viewers, what are those investment products that they should have in their portfolio?
So essentially, first, you have to have a goal, investment goal. Why do you want to save? Second, you have to understand your risk appetite. Are you aggressive investor? Are you average investor? Are you conservative investor? Based on investment goal and your risk profile, you can have a choice of products to invest into. At the end of the day, always remember, your investment should give you real return. That is, महंगाई को outperform कर दे. If you are not outperforming inflation, then you are holding an ice cube on a hot summer afternoon. It will continue to melt.
And let's start with emergency funds because I think that's extremely important considering we have seen a black swan event like COVID. We have seen geopolitical crises that keep popping up. So how important is an emergency fund and where should you invest to create that corpus?
So one, you need to buy protection. You need health insurance, you need term insurance, you need accident insurance, fire insurance kind of things so that you are protected. And if something untoward happens to you, then your near and dear ones don't miss you financially. Certainly, they will miss you emotionally. The journey of investment should always keep something for emergency. There could be a medical crisis in the family. There could be sudden desire to spend money on certain things. The best option for you is savings account in bank or bank fixed deposits or liquid fund. These are the money which are available to you at a short notice. A ATM card can work and give you money at any point of time. So between savings account, liquid fund, fixed deposit, you should have some money available for emergency use.
How much should you put aside in emergency and also how much in term insurance? Because how am I to know what percentage of my perhaps income or expenses should I ensure I keep in these products?
So essentially, you have to ensure that if something happens to you, your family's lifestyle is not compromised. And you need to buy term insurance to that extent that after an untoward incident to you, they don't miss you financially.
You mentioned fixed deposits. Now, as I know, fixed deposits are, there's a lock in of sorts, right? For depending on the period that you select. But oftentimes it happens that we tend to forget to also have that fixed deposit. We all invest in growth assets, but sometimes the money is just lying in the savings account, and you forget that, oh yeah, you should book an FD. And especially sometimes you wonder that is the FD giving you a return that will beat inflation? So could you share the reasoning and the logic behind FD?
So when you're putting money for emergency, your objective is not to beat the inflation. Your objective is to provide liquidity which is needed. What's the point if you don't have cash in hand when the need arises? On the fixed deposit side, it's part of your debt component. And many a times, longer term fixed deposit do outperform or match inflation. The purpose of fixed deposit is to reduce the volatility of the return, to provide that lower risk, lower return kind of edge to the portfolio. At Kotak Bank, we have introduced active money. It gives you convenience of a savings bank account with characteristics of fixed deposit. Money above certain balance automatically gets transferred to fixed deposits of your choice and obviously delivers higher return than savings bank account. But the liquidity continues to remain of savings bank account, and depending upon when you issue check or when you want to withdraw money, the fixed deposit is automatically getting liquidated. Without you doing anything, it gives a combo of savings account plus fixed deposit from a characteristics point of view.
So it's almost like parking your money, the excess money, temporarily, or it's almost like an active management of your savings
Absolutely.
and fixed deposits. Okay. So far we've been talking about emergency funds or where to park your money if you need it in the short term or the near term. Now let's talk about the other category, and that is the inflation beating category, as you mentioned. And I'm sure many of our viewers are interested in that because inflation is a very real problem. So what are the subcategories that you'd recommend investors should look at?
So inflation is the silent killer. It's like a termite which just keeps on taking away your portfolio. And growth investing, which is investment in assets which can outperform inflation, that's the way to beat inflation. But there's no free lunch. Risk and return comes together. You have to take higher risk to generate higher return. Now, direct stocks, mutual funds, new pension scheme, these are all the instruments to invest into the equity market. So the objective of investment is to outperform inflation. Instead of spending today, I will save and earn more money so that I can outperform inflation. Either I can spend money today and enjoy, or save that money, invest, earn more than inflation so that tomorrow I have more monies to spend. Typically, growth investmenting is into equity, which tend to outperform inflation over a longer period of time. But there is no free lunch. Risk and return comes together. Equity में ज़्यादा return मिल सकता है, but उसके लिए volatility, ups and downs of the market you have to bear. The best way to invest in equities on an indirect basis is via mutual funds or national pension scheme. If you are a salaried employee, then NPS is very, very appropriate. There are various tax concessions which are available, which actually end up increasing the return by way of deferment of taxes in national pension scheme. It also does asset allocation for you. There's an auto choice feature in NPS whereby depending upon your age, allocation between debt equity keeps on shifting. A lot of people focus on what to buy rather than how much to buy. But empirical studies have proven it is how much you buy that makes the difference to your wealth rather than what you buy. And this auto choice facility in NPS is a perfect balancer for someone who is not very good at asset allocation. As your age increases, your risk profile reduces, and hence allocation shifts towards safer assets. Equity mutual fund is a Harfan product. It gives you exposure from large cap to thematic, and systematic investment plan is the best way to invest into mutual funds. Obviously, as I mentioned, there's no free lunch. So there is Agni Pariksha in SIP also. There will be periods like March 20 COVID time where SIP returns will be negative. But that's the time when you can't lose patience. You have to remain invested. You have to do SIP top up. And then eventually things will work out. One interesting component of mutual fund is also systematic withdrawal plan. A lot of people know about SIP today, but very few people know about SWP. Post retirement, post when your active income has stopped, you need certain regular cash flow. And that regular cash flow can come by a systematic withdrawal plan of mutual fund. Out of your investment, a pre-specified amount can be withdrawn every month. No matter where market goes, that amount either comes from your income or from your capital, but delivers that particular cash flow. It is tax efficient, it is predictable, and most importantly, if you give enough time, it does deliver better return than inflation. So SIP people are aware of. I'm sure they need to be aware about SWP, which can give them regular cash flow once their active income stops.
I'm so glad you actually brought up the SWP bit because a big chunk of investors actually do not use this facility that the mutual fund industry provides. Could you explain how it's actually more tax efficient to opt for an SWP as a source of regular income versus perhaps other sources?
So many a times people do SWP in hybrid funds, and those do get taxed at a lower rate because of their composition, which is tilted towards equity. Second, in SWP, you are also getting part of your income as well as capital, and that also reduces overall taxation. More importantly, if we compare regular cash flow vis-a-vis other instruments, SWP does stand out because of the deferment of tax.
There's another feature that the mutual fund industry offers investors, and that is Step Up SIP. All of us, thanks to the fantastic job done by the industry promoting mutual funds by Mutual Fund Sahi Hai campaign and SIPs, etc., all of us do our SIPs at the predetermined date every month, and then we tend to forget about it because it's automatic, it's easy, it's convenient. But could you share with our viewers the importance of a Step Up SIP?
So essentially, the concept is very simple. As your income increases, your savings will increase, and that savings will have to be invested. Now, you can do SIP on your initial savings, but as savings pool increases over the years, you can do step up SIP. That way, you will be investing more and more sums of money. The second step up SIP concept could be जब half volley आए तो जोर से बल्ला घुमाइए चौका छक्का लग जाएगा. There will be periods when I say in SIP Agni Pariksha will come. Returns will be negative, returns will be lower. Now, when will returns be negative? When markets have become cheaper from a valuation point of view. That's time to do step up SIP. Be greedy when there is a lot of blood on the street. When markets are cheap, don't be happy with just regular investment of your existing SIP. Do step up SIP so that you are investing more money at lower level in the market. Step up SIP essentially is hitting the half volley for a 4 or a 6.
So a Step Up SIP can maybe really press the gear and go full gear on the power of compounding that any which ways mutual funds offer?
Undoubtedly, the basic concept remains the same. It's you buy more when things are cheap, and step up SIP is that concept.
We've spoken about products now that help you beat inflation and that help you ensure that your money's purchasing power is preserved, or more than that, in fact. Now, let's talk about security. Because, like you said, there's no such thing as a free lunch. There will be certain risks that are associated. Are there any products out there where the risk is perhaps relatively lower?
So, if you're happy with lower return, then certainly there are products where risks will be lower. And there are various kinds of risk. One is the risk of predictability. In bank fixed deposits, you know, if I invest X today, it will become Y tomorrow. In mutual funds, in NPS, those kind of predictability is not there. The second is the ups and downs. When I invest in bank FD, I know that ups and downs will be very, very low. If you are going into equity mutual funds, it's a roller coaster ride. So the risk essentially is not knowing what you are doing. And which is where if you create a balance where there are certain low risk or low volatile products from bank FD to public provident fund to small savings instruments to corporate fixed deposits, bonds, debentures versus growth investment, which includes your equities and real estate and gold. That barbell, that portfolio will give you return which outperforms inflation at volatility which is acceptable to you.
Could you share a bit more about some of those products, particularly PPF, EPF?
So essentially, if you are an employee, there is a provision applicable to you on the provident fund. And nowadays, provident fund is managed by a company or by the government. And government provident fund also goes and invests into equities as it is permitted under the law. Uh, if you are a self-employed person or if you are an employee and who wants to invest more than provident fund, there's something called public provident fund. It's essentially meant for conservative investors who are happy in predictable earnings and who are happy in lower risk and lower return product. One big advantage of PPF and NPS is also that it can't be attached by your security holders or your creditors. That remains for you forever. It can't be attached by the insolvency proceedings. So that way, God forbid, if something goes wrong, at least there is a kitty available for you and your family.
There are two interesting products. I'm just talking from a tax perspective. We just spoke about PPF. There is also ELSS. So let's say if I have to invest at a younger age, let's say for my child, in these products, could you explain the differences, the common features of these products?
PPF is very, very appropriate for a conservative investor. We did one analysis of comparing risk and return versus PPF versus equity linked savings scheme. Both give similar tax exemption while investing under Section 80C. If you had invested 1,50,000 a year for 25 years, you would have made 37.5 lakh rupee investment in PPF. If you had invested similar amount in equity linked savings schemes, the total investment would have been same at 37.5 lakh rupee and the tax benefits available on those investments would have been similar. But because you take higher risk in equity linked savings scheme, at the end of 25th year when we did that calculation, the corpus of ELSS was more than 4 crore, whereas the corpus of PPF was just about 1 crore plus. There was a gap of 3 times between ELSS and PPF for the risk of volatility which you take. Now, PPF is tax exempt, it can be attached by creditors, ELSS is taxable, and it can be attached by creditors. Those are the nuances which you will have to remember. My recommendation will be if you are a conservative investor, go for PPF. You can even utilize that PPF after 15 years with almost regular liquidity. So it becomes kind of your savings account plus with tax-free interest. But if you are a aggressive investors who can take risk, then go for ELSs along with PPF if you want.
Okay, so we've spoken about emergency funds, we've spoken about growth and security. Now, of course, there is gold, which a lot of Indians already invest in. So, could you explain how gold plays a role in your portfolio and the ways in which one should invest?
So essentially, Indians have been investor of gold for centuries and centuries. In today's context, central bankers around the world have also become like Indian housewives. They have been buying gold and not selling. There's a competition between Indians and Chinese and Middle Eastern and central bankers who can buy more gold. This additional buying of gold by central bankers is pulling the prices up. And we believe with the current uncertainty on geopolitical side, many central bankers will like to shift part of their FX reserves to a globally recognized commodity like gold. And hence we believe one should remain overweight gold. Gold prices have done very well over last 5 years. We believe over next 5 years also, as long as central banks continue to buy gold and not sell, gold prices will remain supported. In your portfolio, can you allocate between 5 to 10% of your portfolio towards gold and silver kind of precious metal? Answer is yes. You can buy it physically. You can buy via gold ETF and gold fund, which is available in mutual fund space. Or if you can get in secondary market sovereign gold bonds, that also is appropriate.
Okay, so let's now summarize our entire conversation because you've shared with our viewers a lot of interesting investment products that they should consider. Now, the question is how much to be put in each of these products? So, could you share an asset allocation strategy?
Asset allocation is the most important part, which will determine how much wealth you will have. People focus a lot on what to buy. It's extremely important how much you buy. When half volley comes, if you keep on taking singles, your run will never be adequate. But if you hit every half volley for a 4 and a 6, your runs will be far higher. Now, if you go to a restaurant, you can pick up, from buffet the plate which you like. But if there was only raw ingredients available, will you be able to make the buffet which you like? Answer is most likely no. You need a chef which uses those ingredients to prepare a meal for you. Same thing is needed in the world of investment, in the jungle of investment. If you are like a chef who knows how to cook, please go ahead and make your dish. Most of us are not. And hence you need a handholder, an advisor. At Kotak Bank, we provide this service for our affluent customers where we guide them about their portfolio allocation between debt, equity, commodities, mutual funds, stocks, and so on and so forth. Understand your risk profile, determine your investment goal, and then sit with the advisor of Kotak Affluent to figure out how you want to complete this journey.
So let's say if I had to speak to a young Nilesh Shah, maybe 25 years of age, entering 2025, how would you allocate your investable corpus to different products?
So essentially, one, instead of running around from one product to another product or trying to time the market, I would have become time in the market investor, stay for longer term. Second, I would have taken much higher risk than probably what I have taken in the past because that risk taking gives you the return. Even today, I leave allocation job to my advisor. My space is bit limited because whatever money I get, I have to put 20% in my own schemes under skin in the game circular. I put 10% in NPS, 10% in Provident Fund, and 40% is my tax bracket. So out of 100, 80 is allocated compulsorily. Balance 20, whatever is left after giving to my wife, I distribute as per my advisor's choice.
You're forgetting your daughters and mom also. Okay, so I think this is a very important lesson to learn here that even Nilesh Shah, managing such a large mutual fund, goes to his advisors to ensure that he's properly allocating his assets. So I think for us regular investors who have different jobs not associated with the financial services industry, it's even more imperative to go to a financial advisor. So if I have to divide my portfolio into large buckets, how would we divide it? What are the overall categories?
See, essentially in any plate, दाल रोटी चावल सब्जी सेम ही रहती है. You need some money for emergency. You need to invest for growth. You need to anchor your portfolio via debt. And you need to hedge your portfolio via gold. ये आपके दाल रोटी चावल सब्जी है. ऑफ कोर्स सूप्स एंड डेजर्ट लगाना है तो वो भी आप कर सकते हैं, बट प्राइमरी एलोकेशन बिटवीन डेट, इक्विटी, प्रेशियस मेटल लाइक गोल्ड and emergency funding should be good enough.
So we should now dissect the dal chawal roti a little bit more for our viewers and get those
Yes.
recipes for this basic meal. All right, Nilesh, as always, a very insightful conversation. Thank you so much for joining us.
Thank you.
And thank you, viewers, for tuning in to this new episode of Investments Ki Baatein with Nilesh Shah. I hope it was insightful and informational for you as well. Remember that every rupee you invest today brings you closer to your dreams tomorrow. And it's not just about investing, it's about investing right. Don't forget to hit the subscribe button because we're going to be back with another episode of Investments Ki Baatein. Thank you so much for watching. Stay tuned.